Greetings and welcome to the University of Minnesota Alumni Association's webinar series. My name is John Ruzek, and I'm the Senior Director of Alumni Networks here at the U. Thanks to all the alumni and friends who have made time to join us live today. And today's webinar will be on student debt management and is being presented by our partner, Credible. Today's webinar is part of a free series being offered by the University of Minnesota Alumni Association, where we're having conversations with experts about career life and learning topics. And since we launched the series about 18 months ago, we've had over 4,000 alumni and friends tune in live with us and have had over 9,000 YouTube views of our webinar library. And initiatives like these are made possible in part by our members, so thank you. And if you're interested in becoming a member of the Alumni Association, you can learn more at minnesotaalumni.org/join. The webinar is being recorded and will be viewable afterwards at our website, minnesotaalumni.org/webinars. Just give us a day or two to get it posted up on our website. And if you're online or on Twitter, feel free to use the hashtag UMNWebinar. Would love to hear from you. And if you're a professional on LinkedIn, we have a 31,000 person strong LinkedIn group, and you can find all of our university LinkedIn groups at that webpage noted. Coming up, we also have a webinar happening July 21st at noon. The registration page is not up for this one yet, but the date is set. It's going to be Is Graduate School Right for Me? Being presented by some colleagues from the Carlson School of Management and the University of Minnesota's Graduate School. So registration will get up in a few weeks for that, again, at minnesotaalumni.org/webinars. Before we get started, let me just go over a few household items to help you participate in today's event. You have joined the presentation listening using your computer speaker system by default. If you'd prefer to listen over the telephone, just select telephone in the audio pane of your GoToWebinar panel and dial-in information will be displayed. If you experience audio difficulties while listening via your computer speakers, this can be caused by having multiple software applications open, which can eat up your computer's bandwidth. So feel free to close any unnecessary applications or move from wireless to a hard-lined web connection. Questions are welcome, and you can submit them at any time, and our presenters will tackle them towards the end of their presentation today. Please feel free to type in your questions in the questions pane on your GoToWebinar control panel, and we'd love to hear from you. And it is now my pleasure to introduce today's featured speaker, Nicole Newell. Nicole is the Partnerships Manager with Credible, who is sponsoring today's webinar. She'll be talking about easy ways to manage, refinance, and save on student loans and key considerations when choosing whether to refinance or not. Welcome, Nicole.
Thanks, John.
All right.
Let me go ahead and just share my screen here.
We'll get you that here in a sec.
Perfect. All right, well, thanks, John, for the introduction. I want to first thank everyone for joining us this afternoon. Again, my name is Nicole Newell, and I manage the Partnerships channel over here at Credible, and we're very excited to be bringing this webinar to University of Minnesota Alumni Association. So first and foremost, just a quick housekeeping item. I just want to point out that Credible is not a financial advisory firm. So I'm in no way a financial advisor. The purpose of this webinar is strictly educational. Shouldn't be considered financial advice by any means. We're really just here to provide education around student loan refinancing and to help you guys better understand student loans. So just a quick overview. We'll go over an image of the student debt crisis as it exists today, the definition of student loan refinancing, how to refinance student loans, things you should consider, a few key terms, how to get the best refinancing offer, paying back your student loans, and then I'll have my colleague Kyle go into a demo of the Credible process, and then we'll conclude with a Q&A session at the end. And one quick thing too before I jump into this is pretty high level just because, you know, student loan debt is a pretty complex subject. So if you guys do have questions, go ahead and type them into the question box and we'll do our best to answer all of them at the end. So here we have an image of what we like to call a student debt crisis. And we have this here just to demonstrate the massive growth student debt has seen over the past decade. So this particular chart is actually from 2013 from the Federal Reserve Bank. And as you can see, it's nearly quadrupled from 2003 to 2013. As it exists today, we're currently around $1.3 trillion in outstanding student debt in the United States. And among that $1.3 trillion in outstanding student debt, the national average of student debt upon undergraduate graduation is $33,000. And this number doesn't account for any sort of postgraduate work either, so this is strictly undergraduate. So what is student loan refinancing? So student loan refinancing is where lenders will pay off your loans from your existing lender. So similar to mortgage refinancing, so you might be familiar with it in that sense. So the result is a new loan with that new lender at a potentially lower interest rate or potentially lower monthly payment. And as you can see here, there's an example of Cole, who was a graduate. He graduated in 2010, and a lot of his federal loans were taken out at the peak of federal rates. But after refinancing, he was actually able to reduce his interest rate from 8.9% to 3.75%, which ended up saving him over $40,000 in total interest over the life of his loans. So why does student loan refinancing exist? So student loan refinancing exists because lenders saw the opportunity to help graduates who did all of the right things. So you got your degree, you have a good job, you're making consistent payments on your loans. So there's no reason you should be tied to that high interest rate that you were given at 18 years old when you had little to no credit history. And there's a couple of other things as well that affect that. So a private lender will be subject to market rates and not only have market rates dropped, but your chance of default as a borrower is lower post-graduation as well. So what that means is that a bank is willing to offer you a lower rate and they're willing to take a little more risk on you. And then finally, private loans are personalized and they're not a one-size-fits-all approach like federal loans are. So for example, federal loans are dictated by whatever year you took them out in, and they don't take into account your credit history, your employment, or any other options that would make you a good borrower at this point in time. If you take advantage of private loans, those are customized for you, your history as a borrower, your income, your credit score, and so on. So how do I refinance my student loans? So without Credible, you're going to have to find different lenders, sift through all the different banks, the credit unions, and new lenders who refinance. So you'd be responsible for finding all of those lenders, submitting individual applications to each one of those lenders that you want to be considered with, and then you'd have to try to compare those and select the offer that makes sense as you're attempting to make sense of all those different offers in front of you. With Credible, you can fill out a simple form. This has about 13 fields and takes around 2 minutes. And from doing this, you're able to compare pre-qualified offers from multiple lenders on a single dashboard. So you're really able to compare the offers based on what matters most to you, whether that's reducing your monthly payment, reducing your overall repayment, reducing your term, and so on. So now we're going to discuss a few things you should consider if you're going to potentially refinance. So depending on your student loan repayment preferences, we typically see two types of borrowers. So we see those looking to pay off their loans faster and others looking to reduce their monthly payment. As you can see here on this slide, a short term will benefit from both the lowest interest rate possible as well as a shortened term, but your monthly payment will usually end up being much higher. And a longer repayment term results in a higher interest rate over the life of your loan, but an overall smaller monthly payment due to that longer term. So as you can probably imagine, longer terms will end up increasing the total cost of the loan significantly. And then if you look at the table below, you'll notice from the 5-year to the 10-year to the 15-year term, there's a savings of almost $10,000 in those different terms, even with those slight increases of interest over an additional 5 years. And another thing to note is that most lenders do not have prepayment penalties, so you can take a longer term loan and pay it off as quickly as desired, while maintaining the flexibility of a lower required monthly payment. So you could potentially take out a 15-year loan and pay it off in 5 years if that's something that makes sense for you. And that's true for all education loans. There's no prepayment penalties. So another thing that you're going to want to consider is if you would like a fixed or a variable rate. So some of the fixed rate benefits are that it's predictable, it's set for the life of your loan, so you really have no risk of losing that rate. Some cons to that would be that you might end up leaving some savings on the table, since those fixed rates generally start higher than variable rates do. As far as variable rates go, the pros to that are that you have those lower introductory rates. So if you're able to put a lot on your loan up front, you can potentially save significantly more. And the downside to that is that there's less predictability, making it a little bit more difficult to budget. And you also have the possibility of interest rates significantly increasing over the life of your loan. So again, just a few things to consider. So should I add a cosigner? People who should definitely add a cosigner are those with a 680 credit score or lower. With that being said, it's really never a bad idea to add a cosigner. So if you know a cosigner who has a strong credit history and a high income, someone you have a strong relationship with, it's really never a bad idea to have them on there. And the reason for that is that all this does is lessen the risk of you as a borrower to the lender, and so they're able to offer you better rates. So a few benefits of adding a cosigner is that you can have a greater chance of approval. Again, it lessens the risk taken by the lender. You can potentially lower your interest rate. And the drawbacks would be they can be difficult to find. The cosigner can be held liable to repay, and they can take multiple years to remove depending on the lender that you choose. And so government repayment programs. So basically if monthly payments are straining your budget, as a borrower you can lower your monthly payment by enrolling in an extended repayment plan or an IDR plan. And so what this does is it ties your monthly payments to a percentage of your discretionary income. And one thing to point out too is that if you do choose to enroll, because you are stretching the payments over a longer period of time, this can end up increasing the total amount of principal and interest repaid compared to the standard 10-year plan. All right, so just a few key terms. The first one being deferment. So deferment, so basically if you're in a situation that makes it difficult to make payments on your federal student loans, you can request a deferment from your loan servicer. So a few examples of borrowers who may qualify for deferment are those who are enrolled at least half-time in college, those who are unemployed, and those who are on active duty military service during a time of war. And what this means is that if you're approved, you can stop making monthly payments for 3 years or more in some cases. And then just something to point out, depending on the type of loan, the government may pay the interest that would otherwise accrue, but for unsubsidized direct loans or plus loans, you will be responsible for interest rates that accrue while your payments are in deferment. All right, forbearance. So if you're having trouble making your monthly payments on your federal loans, but you don't qualify for a deferment, you might be able to stop or reduce your monthly payments for up to 12 months by requesting forbearance. So you will be responsible for interest rates that accrue on your loans while you're in forbearance, but your loan servicer is required to grant forbearance in the situations below. So if your monthly student loan payment is 20% of your total monthly gross income, if you're in a teaching position that qualifies for teacher loan forgiveness, or if you're in a medical or dental internship or residency. And then just one thing to point out here as well is that your loan servicer does have the option of granting this if you're experiencing financial hardship or illness. All right, so how do I get the best offer? First and foremost, be in good credit standing. If you're not there right now, that's okay. There's things you can do to get yourself back up to good credit standing. And then at that point, you can start to look at refinancing. Have a low debt-to-income ratio. Have work experience. We recommend 12 months or more. Be aware of current market rates. Apply with a cosigner if you can, and compare multiple offers. And that's where Credible comes in, where we're able to allow you to compare multiple offers on that single dashboard. And then another thing to keep in mind is that you can actually refinance your student loans as many times as you want. So a question we get asked a lot is, when is the best time to refinance my student loans? And realistically, you want to consider refinancing at multiple points throughout your career, when you've gotten a pay raise, or if you potentially paid off another form of debt, etc. So it does make sense to consider refinancing multiple points throughout your career. All right, and now I'm going to hand it over to Kyle, who's going to go through a demo of the Credible process. And again, if you have any questions about anything that I just went over or the Credible process in general, go ahead and type those into the question box, and we will answer those at the end of the demo.
Okay, nice to meet everybody. So what you are looking at right now is the Credible homepage. They are looking at that, correct?
Yep.
Cool. So the reason I bring this up, and we'll get into the form in a second, is I just want to give you a sense of what Credible offers to borrowers, which is a simple, transparent experience for them to understand their options for student loan refinancing. So this homepage highlights that. It's an instant request. It will not affect your credit score. Also, if when you get to the site you just want to have a little bit more information about student loan refinancing and how refinancing works in general, you can watch this video that we've produced as well. So if you hit Get My Free Rates, that will actually send you into our form. And this is what our form looks like. As you can see, very simple and clean by design. Just want to direct you over to the right here for a few items. One, we just, again, reinforce how Credible works. And then these common questions are actually dynamic. So as you go through the process, the common questions will change depending upon where you are at in the process. And lastly, and I think Nicole mentioned this, our client success team information is right here. We want to encourage you to reach out to our client success team whenever possible. This is a detailed process that has a lot of different factors, as Nicole went through, and they are our internal experts to give you a sense of what the options are and help just guide you through both the process on the Credible side and the lender side. So back to the form itself, it's just 13 fields worth of information that you're going to be filling out, some basic information. Once you complete that, then you will create an account on Credible here. You'll do so just by entering an email address and choosing a password. And then you'll see our terms of use at the last section here, and we mention again that this process will not affect your credit score. So it's important to understand how we're able to do so, how we're able to get you in front of personalized offers without affecting your credit score. And I'll just detail that a little bit right now. So essentially it comes down to the relationships that Credible has built and the integrations that we've built through those relationships into our process. So on one side of the coin, if you will, is our relationships with the top credit reporting agencies. So likely these are names you've heard of like Experian, TransUnion, and Equifax. Now what those relationships allow us to do is run a soft credit inquiry on you as a borrower. A soft credit inquiry does not show up on your credit report at all, has no effect on your credit report, but it does give us the necessary information combined with the information that you fill out in the form above to run up against the underwriting models of our lender partners. Now, underwriting models, for those that don't know, are basically how a lender assesses risk of a borrower. And depending upon the risk assessment, they'll either be able to offer you, in this case, a refinance student loan or not. And depending upon the level of risk, the types of offers that they are able to send to you will be determined by that underwriting model. Now, each lender has their own proprietary underwriting model. We, as part of their agreement to be on the credible marketplace, insist that they actually give us their underwriting models. And we house those underwriting models on the back end of our site. So that's a long explanation, but basically what it allows us to do is combine the information that you've given us with the soft credit inquiry information, run it up against those underwriting models that we house on our back end, and the fruit of that is, as you'll see here right now, is for qualified borrowers, we can get you these offers instantaneously in a kind of kayak style dashboard, as you can see here. Now, I just want to note this is a live demo, so this is the actual experience, and also we have what is called a smart filter on here. So the smart filter, as you can see, as you can read right there, displays the most competitive options. We are committed to transparency, and we want to make sure you have all of the options in front of you. But in the case of this fictitious borrower that we've created here, Colin, who's received 28 different offers, there's a lot of noise within those offers, so we reduce some of that by having the smart filter on. Now, if you prefer to just see all of the offers, you can do so by unchecking that and viewing all of those. Now, back to the actual offers themselves. It's important from a user experience standpoint that Credible breaks out all of the important elements of each loan offer that a borrower has received. So the term, meaning that the amount of time it takes you to pay the loan back, the APR or the interest rate, the rate type, so variable and fixed, the monthly payment, and we actually, from a variable and fixed standpoint, we explain here what that means, the monthly payment, and the total cost of the loan. Now, you can toggle these column headers to basically float what are the most important elements of the loan for you to the top, or you can actually filter, just like you would on Kayak or Expedia, for certain elements of a loan that are important to you. So let's say, as a borrower, you're only comfortable with a fixed rate loan product, and you want to be able to pay it off in 15 years or less. And from a monthly payment standpoint, you'd like to be paying less than $400 a month. After getting those filters in, we have 4 offers that from the 28 that fit that criteria. And now you can really dig into each one of these offers and compare them on an apples-to-apples basis. So it looks like we have an offer from 4 different lenders, all within the 12 to 15 year range. Now you can learn more about College Ave and a lender description here, what this rate includes and does not include. We default to including the auto debit discount, but you can actually uncheck that if you prefer. And you can also see what kind of discounts and benefits are available, in addition to what you'll have to upload as the final part of the process with the lender. You can do so, you can learn more about each one of these lenders in the same way, so just clicking that down arrow. Now let's say after you've evaluated your options, this rate from Citizens Bank is the most preferable because it allows you to pay the least, actually let's just say this College Ave offer might be the best because it allows you to pay the least amount per month and the lowest APR. So you'll hit choose this lender. This lets you know that you're looking at a pre-qualified offer. It is pre-qualified in name only. At this point, Credible, because we house the underwriting models of these lender partners on our back end, we haven't communicated anything to the lenders. So they're essentially not aware of you as a borrower. We insulate you from basically their outreach. In order to turn it into a firm offer, we actually need to communicate you to this lender. And in order to do so, you'll fill out some more information on Credible, and this is what the experience looks like. Now, at any point in this process, and you can see what the steps are in terms of form here, you can walk away and none of the lenders will be aware of you. So we won't submit any of the information to any of the lenders until you finish the process and say, submit my information. And even at that point, only the lender that you have chosen, so in this case College Ave, will actually receive your information. And it's just so that it makes it easier when you get to College Ave to start the process with them. You're not re-entering a lot of information. So a lot of the information that you've already entered on Credible is transferred over to, in this case, College Ave. So basically that's the process overall. I think it makes sense to open up to questions now, both in terms of the Credible experience and just refinancing in general.
Cool. Thanks, Kyle. I'm going to hand it over to Jimmy, he's our loan expert. He's going to go ahead and help answer these questions. So we'll go ahead and get started. And at the end, I will also put up a contact page where you can download our refinancing guide. You can contact our support team and by email and phone number. But for now, I'll go ahead and pass it over to Jimmy.
All right, this is John here. We'll get Jimmy on the line here in a second. I have some questions ready to go that people have submitted. Are you good to go, Jimmy?
Yeah, ready when you are.
All right. Yeah, and I apologize if any of these I read, if they've been covered already, just restate that. But we have some questions lined up, so I'll just kind of read them as they are. One of our participants has a question about consolidation. I have several student loans at different interest, and I'd like to consolidate the high interest loans while leaving the ones that I have at 2 to 4% interest alone. Is it possible to consolidate only high interest loans, or do I run the risk of having to consolidate my low interest loans as well?
Yeah, that's a very common question we get. Basically, you can pick and choose which loans you wish to refinance. So if you want to keep this shorter interest rates, then that's perfectly fine. Just got to make sure that you meet the minimum balance requirements by the lender. So, for instance, if you're only refinancing $5,000, you may be only eligible for one lender as opposed to 3, depending on how high the balance is. But yeah, absolutely, it's up to you to pick which loans you want to refinance. It's perfectly fine.
Okay. And the same person asks, if I refinance, how does that affect my ability to get loans in the future, like home loans?
That's a really good question. I don't have a very specific answer necessarily, but refinancing is just simply, based off your current credit situation. So as long as you're on time with payments, obviously with federal loans, there's a couple more protections per se that a user would get with federal loans. Private, maybe if you default or if you're late on payments, those could be credit strikes, which if later on you were to get a home mortgage and it impacted your credit. But if you've always been good with your payments and your payments may be lower now that you refinanced, you should be fine and it shouldn't affect your ability to get a home.
Okay. One of our participants asks, if I have already refinanced through the federal program, is there an option to refinance again through Credible or someone else?
Absolutely. So when you consolidate through the federal government, your loan somewhat changes in that now you only have one servicer as opposed to, say, 3 or 4, which you did before. Now it's an average interest rate. It's almost easier because now everything's combined into one loan. So when you come to Credible, you can just simply, you only have one load to add in, so it makes the process a little bit faster. And all of our lenders do refinance previously consolidated loans. Alternatively, you can also say if you refinance and then you're in a better financial situation in 6 months, you could always refinance again. So there's no limit on the number of times you can refinance or potentially consolidate then refinance.
Okay. Another person asks, is there a cap on the interest rate with the variable interest rate plans, or a max on what percentage it could increase over a certain amount of time?
Yes. So the variable rates are based on LIBOR, and then plus a variable percentage. These rates do have caps. The caps, I would say, are rather high in that, the cap could be 12%, but the best thing to do is to just look at it from a historical perspective. I think we actually have some content we'd be happy to share with you on this, on how interest rates on variable loans have progressed over time. There's never really been a case where variable rates have just jumped 3% within a year period. It's usually a very gradual process, slope. So if you get potentially 2% lower on a variable rate, chances are over, if it's a short-term loan, it's not going to get any higher than if you were to have a fixed rate. I mean, these are all obviously assumptions, but it kind of depends on the individual. If variable rate, some people like the risk, and if they know they're going to pay it off quickly, those sometimes are very good loan options to pursue because of the tempting low rates. For those of us with more anxiety, maybe the high interest rate cap could be a concern, but we'd be happy to share out some content on how variable rates have progressed if that would be useful.
Mm-hmm. Another person asks, if I decide to refinance and then the government forgives the loan, will I have a chance to be included in that?
That's a very good question. I'm not sure. My guess would be that now it's a private loan, so most likely not. However, the chances of that to happen in the next 10 years is very unlikely. The student loan debt is just too large. There's been a lot of state-by-state reforms to try and help students with forgiveness, but I don't see that likely based on all
the government would never give up $1 trillion.
Yeah.
Okay.
I don't have that's partly an opinion, but I guess the answer would be no.
Okay.
So,
and apologies if this question was already addressed, but will each lender on Credible run a hard credit check?
So Credible is basically a two-step process. First process being short form, and then once you fill out this short form, they do a soft credit inquiry to see which options you could pursue. So you could get 3 lenders, 2 lenders, and at this point, there is no communication with the lender. So this is purely on Credible. So until you actually select an offer that you wish to pursue and then finalize the rate and we send it to the lender, that's when the hard credit inquiry will take place. The hard credit's obviously used to, make sure there's no just knockout criteria. It's just standard practice by all the lenders. However, if you're rate shopping, you can do as many hard credit inquiries within a 30-day period as you need.
Okay. Okay, this is a 2-part question. I'll ask the first part because it's somewhat lengthy. First question. Is it ever a good idea to switch from federal loans to private loans? And does removing a cosigner have an impact on the borrower? I'm set to release my parents from my undergrad loans this fall, and the lender couldn't tell me what impact, if any, it would have.
Great question. So for the first question, are private loans any better than federal loans? From a repayment standpoint, they're not much different. Depending on what federal loans you have, whether it's subsidized or unsubsidized, you may be eligible for forgiveness or maybe deferment or forbearance. So if you go back to school, you could potentially not accrue interest while you're in school. They're effectively the same thing. Your servicer might be a little bit different. Kind of just depends on that experience as well. If you like your interest rates, and I think that's probably the number one concern most of our users have is the interest rate. And if you could get a lower rate with a private loan and don't have an intent of, you just want to get your loans paid off, I don't see any concerns with switching to private. However, if you have low interest rates on your federal loans, I would probably just stick with them, just if for any security issues.
Mm-hmm.
In terms of cosigners, so the value of a cosigner is just simply that if you can't repay the loan, your cosigner, it's like this extra backing of security for lenders. I'm interested in what loans this user has because most federal loans are not cosigned. It could be a parent loan, which would actually be in the parent name. Private loans can be cosigned, so potentially this user already has private loans. But once a cosigner is removed, the financial, it basically just is purely like you are 100% responsible for the loan itself. That is actually, so when many users come to refinance, they include cosigners to get lower rates because maybe they're young, out of college, a couple years out, and their credit history is a little bit short, so they ask their parents to cosign, and we've seen large reductions in rates. And then at that point, many lenders offer cosigner releases. So if you want to say after 2 years of repaying and you showed that you made consecutive on-time payments, they'll allow you to remove your cosigner, and then the loan's purely in your name. So if you're worrying about burdening someone with that debt, that's probably the main reason why people like to remove cosigners, is just like it's a burden on the other party for kind of helping you out, and it's
Mm-hmm.
a respectful thing to do.
All right, and then the same person just asks, how many years into a payment? Okay, sorry, I'll start over. Also, how many years into payment or getting a substantial raise is a good time to ask for refinancing? This person's understanding is that federal loans aren't adjustable because rates are set by Congress, but what about private loans?
Yeah, that's a great question. It definitely has to do with the underwriting model by the lender. I would say the first big, so when a lender evaluates your ability to refinance or get a lower rate, the first thing they probably do is look at your credit. So depending on your credit score, you get pushed into different buckets, and then within those buckets, maybe your income is a factor. But so I think what we found is that actually credit monitoring is one of the best ways. If you're on a cusp of a bucket that we know that will get you into a lower bracket for a lender, then that might be a better opportune time. So exploring things like credit monitoring and tracking your credit score over time might be actually more valuable than, say, a $10,000 raise. Lenders usually look at your annual income as well as your debt to income. So, but if the raise dramatically increases, the amount of capital you have per month, obviously that would be very helpful as well. But I would say credit bracket is probably a little bit superior to, say a small raise or medium-sized raise.
Okay. Well, we definitely have some more questions lined up. So again, if any of these have been addressed already, feel free to, be brief in the response if I'm asking things that have already been covered. Because for myself, student loan management isn't my expertise area by any means. So just passing along the questions that are coming here. Next one, can you refinance some of your loans while leaving others at their current rates at their current lenders?
Yeah, I think this was the first question we addressed.
Okay.
Yes, you can. You can keep your low interest rates and refinance only high ones. Just be mindful that you need to make minimum balance requirements.
Okay. And I think this was already addressed. Private and federal loans can be refinanced and consolidated together with credible lenders.
Yep, absolutely.
Yep.
Almost all lenders now do both.
Do credible preferred lenders have fees for paying off a loan early?
So this is actually an interesting question. No, just for your own benefit, I think it's a law that you cannot charge prepayment fees. Lenders just technically use this as like a marketing tactic to get you to, consolidate or refinance with them. But it's actually a law state. The law states that there are no prepayment penalties with any type of student loan. So you're protected.
Mm-hmm. All right. Another question. Discuss closing costs for original loans in each instance of refinancing. This individual is just wondering, how does Credible make your money for this service?
So first of all, there's no fees with Credible, as well as there's no origination fees with our lenders. So the rate that you get on, say, a pre-qualified dashboard is actually the rate you would pay in total. There's no this is the final cost for you. So then Credible, how they make money is to pass the savings on to the consumer. We just pair with the lenders, and we're paid an origination fee. So we're only paid if you actually close a loan. So it's on a volume basis on bringing people to the lenders. So it's kind of like lead generation, but we don't pass so every user, even if they don't refinance, it's absolutely free. And we're only paid if the loan closes.
All right. Next question. In the live demo, the College Ave group offered a benefit of Cosigner Release. What is a Cosigner Release, and what is the benefit of having that feature?
So Cosigner Release, many people, I kind of touched on this earlier, are apprehensive to add a cosigner because your cosigner is liable for the loan. This is obviously like an extra loan on their credit and could be a hindrance to them as well. So Cosigner Release is you don't have to wait, say, 15 years for the loan to expire to remove your cosigner. So if you just, after X amount of on-time quality payments, your cosigner can be released and the loan is fully in your name.
Okay. I am trying to, okay, I'm just kind of going through some of the questions here, trying to make heads or tails of some of these. All right, a lot of questions about consolidating both private and federal loans. We've talked about those. Okay, this one may have been covered, but if I refinance with a private lender, would I still be eligible for the Public Service Loan Forgiveness Program?
Unfortunately, you would not.
Okay, thank you. How long are the proposed rates an option for as I make a decision with my significant other?
Yeah, so if you request pre-qualified rates through Credible, rates are good for about a 30-day period. This is probably based on credit changes that could happen within a month. You can always just pre-qualify again. So if you came through and I think after a certain amount of days, you could just submit another request if your information changes.
Mm-hmm.
So.
One person writes in, does Credible have a similar solution for taking out the initial loan?
Yeah, so we also offer a student loan platform. So credible.com/student-loans. So we offer a range of products from similar lenders from refinancing as well as just other very common student loan lenders. They're all private student loans, so we don't offer federal loans. Those will be given through your university, but if you need extra funds for college, we can absolutely help you through that process.
Mm-hmm. All right, here's one question. If someone refinances government loans through these private banks, then goes into bankruptcy, and since the loan type would have changed to private, would it be eligible for bankruptcy if circumstances warrant, like severe hardship?
I actually believe that all student loans, whether federal or private, cannot be forgiven in bankruptcy. It's a very, very slim scenario in which this could happen. And that's just for private. Federal loans are never forgivable in a state of bankruptcy. So,
Okay. If I refinance, or when I refinance a student loan, do future creditors know it is a student loan?
that's an interesting question. I believe so. Yes. Yeah. They'll appear in the same way on your credit report as your federal loans. So if you use like a money management tool like, say, Credit Karma or something that lists your loans, they should all be listed there.
Okay. And I think earlier we addressed the question about if fees, if paying off a loan early, if those exist.
Yep, no fees.
Okay. All right. Would co-signing with a spouse help reduce interest rates? Do they look at the combined income and debt of the couple when considering the debt to income ratio if you have your spouse as a co-signer?
Great question. So I think, like I kind of mentioned before, the first thing that they will look at is your credit score. So they will just take, so if your spouse has a higher credit score, that will be the credit score that they use. And then depending on the lender, they also take the higher of the two incomes. So when they do your qualification, they'll just take an individual and make an assessment off of that rather than combined.
Okay, great. What is considered a competitive rate in the private student loan industry right now?
That's a really good question. This kind of depends, I would say, on what your current federal rates are. Depending on what year you graduated or what you went to school, rates could range from anywhere from 3% to say upwards of 7.5%. Also depends on the grad degree. We look at it more in terms of like rate reduction. So a rate reduction between 1% to 2% is actually like very significant. I think it's also beneficial to note, like, if you just look at how much a small rate reduction can actually impact based upon, like, if you have a high loan balance over the life of a loan, even a small interest rate reduction can actually have a huge impact, especially if you're just interested in making minimum payments and stretching out the loan. A small incremental change can actually make a huge difference.
Okay. And this one might have been covered. When refinanced, are these loans considered and or listed as public or private? And when I think the person just wrote some more, these government student loans. So when these government student loans are refinanced, are they ultimately listed as public or private?
Once they're refinanced, they will be a private loan.
All right. Yeah, I think we've had quite a few questions, so I'm just kind of scrolling through here. If I've missed anything, if we have a few minutes left, can maybe take one or two more.
Cool.
Well, I think that's okay. Actually, one came in. Did the speaker say the interest rates on your loan depend on your degree? Can you expand on that?
Yeah, there's just a lot of factors. So, for instance, we have a lender, Purify, and basically they value, they're these alternative lending underwriting models, and basically they look at like potential. So sometimes they may value a bachelor's in computer science as a different credit bucket than maybe, say, a bachelor's of arts degrees based upon likely salaries for those given professions. that's probably the only lender I can think of that weights those terms, but yeah.
Okay. We had actually a couple other questions coming in. My credit score is over 800, but I don't currently have a full-time job. How long, once I have a job, should I wait to apply to refinance? I'm concerned about the Fed's hiking rates in June.
Yeah, that's a good question. I believe, well, congrats on having such a good credit score, first of all. I think one thing to note is the pre-qualification process. You can do it any time, so that's nothing you should be waiting on. Depends also on maybe how long you were without income for that given year, but I would probably wait between 6 or so months. But yeah, happy to help clarify that if that's needed.
Okay.
Yeah, I think it's about, they look at the last couple pay periods when they, lenders finalize and review your documents. So just being able to have like a sufficient, proof. You also are required to enter your employer phone, so lenders can make, judgment calls based upon like potential conversations about, work history, etc.
Okay. Who can use Credible? Graduates from other institutions? Is it a free resource? That's a question that just came in.
Yeah, so we offer refinancing products to those freshly out of undergrad up to those who, just completed their medical degree. So kind of cross-industry, cross-university. We can even do for-profit schools, and the service is free.
Okay. If I am under 24, will I need to have a cosigner when I refinance?
That's a really good question. So there's just a couple, factors that the lenders will look at. So potentially, do you have more than 2 years of work employment? What is your credit rating? What is your debt to income? We've absolutely seen people 24 years old qualify and get good rates on their own, but this could maybe be a smaller niche. But I would say you could try and pre-qualify on your own, and if it doesn't go well, consider adding cosigner.
Okay. Question, a clarification. Is it true that once you refinance into a private loan, there are not safety programs such as forbearance, deference, etc. in case of financial hardship?
Yeah, in terms of forgiveness, it's usually not an option. However, deferment, forbearance, it depends on the lender. Some of our lenders offer employment protections. They can offer deferment, forbearance. It just depends on which lender you choose. And we, on the Credible dashboard, we try to make this clear on what benefits you would get with each lender.
Okay. Questions are still coming in. If in process of buying a house, how long should I wait before refinancing student loans?
Can you please repeat the question?
If this person sounds like they're in the process of buying a house, so she's wondering, how long should I wait before refinancing student loans?
Very good question.
So there will be, this is Kyle, so there's a couple things to consider. That there will be, if you go through the pre-qual process, there's nothing that is going to affect your credits. Just check what you have. If you see a rate that you like and you want to move forward with it, that lender, as the final part of the process, will run a hard credit inquiry. So that could affect your credits, or that will affect your credit score. Now, how much it affects your credit score is somewhere between 3 and 7 points, typically with a hard credit inquiry. So you should consider that if you're talking to a mortgage broker and they say that you're on the edge of getting a 5 to 7 or 3 to 7 points could affect your ability to get a great rate on your mortgage. But what I would say is, first, there's nothing preventing you from just checking. It's only if you want to move forward with one of the offers that you should consider a 3 to 7 point hit on your credit report and how that affects your ability to qualify for a mortgage.
Yeah, and I would add, maybe just finish the mortgage process, wait a month or two. That might actually affect your credit, so same scenario, just reversed. And then see what type of rates you qualify for after you finish the process through the pre-qual tool.
All right, and last question: does the Credible website offer any sort of analysis on the Okay, I'll start over on that. Does the Credible website offer any sort of analysis on the lenders, such as does this lender have great customer service? This one not so much. Sounds like they're wondering about if you have any type of rating system with the lenders on your website.
Yeah, so if you go to the Credible, so credible.com/blog, I believe on the right-hand side there's a Lenders tab, and then under those Lenders tab you can click on Refinancing. That has a review of all our lenders. Alternatively, off the main site, if you proceed to the footer, there should say like Refi Student Loan, Refi Lenders. If you click on there, there'll be lender profiles, so each lender's benefits, what they offer, what they don't offer. And I believe there's a Learn More button, and if you click on that, there's like a 4-block module towards the bottom, and it will say like read a review, say on Purify, and that will link you directly to that lender review, which talks about their customer service and like reviews we found. So I guess I would just say go to credible.com, go to the footer, click on Refinancing Lenders, and then all the content should be linked.
Great. Well, Nicole, Kyle, Jimmy, thank you so much for your time today and sharing some of your expertise. I really appreciate it.
Yeah, thank you all for attending. If you guys have any additional questions, feel free to contact our support team. Visit the University of Minnesota Alumni Association partner page, and there's also an FAQ page that's listed on this slide as well.
Wonderful. Thank you so much.
Thank you.
All right, that concludes today's webinar. Just want to thank all the members of the University of Minnesota Alumni Association who make initiatives like this webinar series possible. Thank you so much. Because of members, we can enrich the lives of alumni, support student success, and make a better University of Minnesota. So if you're not a member, consider becoming one today at minnesotaalumni.org/join. Thanks again, everyone, for joining us and being an active member of our worldwide community of 455,000 plus University of Minnesota alumni and friends. I hope you have a great day. Bye.